Hello members and welcome to the Fat Profits Macro webinar. My name is Roger Malik, your host for today's webinar, and joining me today is our founder and CEO and fund manager for Fat Profits, Angus Geddes. Angus, welcome to the macro webinar today. We missed you last week, well, you're back and we're glad to have you. How are you?
Yeah, good afternoon, Roger. Very well, thank you. Good to be back in the saddle and back with you today on the webinar.
Absolutely. Look forward to your insights today, and I'm sure members are ready. So before we get started, our presentation from Fat Profits is general information only. We don't provide any specific personal advice. If you're looking for that, please see your financial advisor, and past performance is not an indicator of future performance. Now, we do have a Q&A session, so if you've got questions in today's webinar, what we'd encourage you to do is to email them to members@fatprofits.com.au, because this one is a recorded version, so you can please email a question and we'll get back to you. All right, moving on to the first couple of topics. We'll look at the market update from last week to this week, and yes, we have seen pretty much red around the world, with the exception of the last 24 hours. We've seen the US markets go up and Australia as well today, so that's helped the matters. But all in all, mostly the trend has been down in the short term. If you look at the year to date though, most of the markets around the world are up, which is pretty good for investors if you've got some skin in the game. Not good if you're completely in cash, then you're probably still waiting. But Japan certainly leading the way, Europe as well, US of course 15% up, and Australia not too far behind. We're also right in the mix there. So all in all, pretty good year so far for investors, but of course there are headwinds we will talk about today. So let's start with Australia. So we'll paint the picture for you, Angus. Recently today, we've seen the inflation numbers come out over the last month. So this is for May, and the expectation was 6.1% headline inflation, and they've now come to 5.6%. Very good news for pretty much everyone, and especially for the RBA. Takes some of the heat off, and this is the biggest drop they have seen for a long time. Now, before we take your insights, I'll paint the picture a little bit further on inflation and Australian business background. This chart shows CPI, which is the grey bar, versus the unit profits costs from business, and that's what really has been driving and outpacing inflation since 2020. As you can see, prior to that, all three, the labor costs, inflation, and the profit costs from businesses were in line with each other. But since the pandemic, businesses have been driving this inflation, and that's really been something that the RBA is now finally looking at. And the other thing, talking about businesses, and Angus, you pointed this out in the Daily Fat Chat earlier today, is that the business collapses in Australia is now starting to go up, and especially in the construction industry, which you can see on the left-hand side. The blue bars is 2022, and the orange bars is 2023, and you can see 1,600 businesses have gone under in construction alone, and pretty much every other industry. 2023 has been pretty bad, and we have 868 businesses which have collapsed just last month, and that's no good. So on that note, Angus, I'll pass it on to you to get your insights first on inflation numbers, because the Reserve Bank are meeting next week to decide the interest rate hikes or not. So what are your thoughts on the inflation numbers and also the business profitability in Australia?
Well, I think, look, first of all, we did get a better inflation number today, which is encouraging, and the market did react to that favourably. But if you look at that chart of those inflation rate prints, for Australia, it's been very erratic and quite volatile. 6.7, 6.8, 5.6. I mean, it's up and down. It's all over the place. Well, my concern with the inflation rate is not only that it's going to remain still really elevated for some time, but the wage bargaining agreements and the wage award increases by the government have really not yet manifested itself throughout the economy. In other words, 63% of the businesses in Australia take their lead from the award wage, and so I still think that wage pressure is going to be a problem. And then I guess the other point about this particular graph, the cost of profits has been outpacing inflation since the pandemic, and this is really what goes back to what Governor Lowe was saying about productivity. Productivity in Australia needs to increase, and what we've seen is it's really stagnated. And of course, that was one of the concerns that he's got. So, you know, my view is that the RBA have got more to do on the rate tightening cycle. That the cash rate at 4.1 is not going to be high enough. It's still well below the inflation rate, and that the RBA are likely to go again with another rate hike. So I think there's a good probability that they move next week with another 25 basis point hike, which is in line with what a lot of other central banks around the world have been doing over the last month. Rog?
Oh, sorry, Angus. Can you hear me now?
I can hear you now. Did you have your mute on?
Apologies. Yeah, I unfortunately hit the mute button. So yeah, I agree with what you're saying, and look, that's in line with what's happened around the world in the last month or so, UK and Europe as well, certainly raising rates. But moving on to one of the concerns for the economy here is that there's a lot of fixed home loans, and this chart really shows you a huge number of fixed rate loans are due to expire in the next few months and leading into even 2024. So that's going to be a big part of the unwinding, and we will need to keep an eye on this because, of course, that's going to impact, you know, their, I guess, the savings versus the spending and consumer habits, because these loans are pretty high now. The final thing in Australia, before we look at the ASX chart, is the PMI, the manufacturing data, which are also starting to slow down as well. And this is not just in Australia, by the way. In the last week, we've seen in the US, in Germany, in France, in UK, the manufacturing is really starting to slow down. And that looks like it's heading in the wrong direction, again, slowing the economy right down, and this probably is not the end of it. So Angus, your thoughts on that, or the ASX as well? Maybe we can talk about all of that together. The ASX 200 has rebounded today, but otherwise the last week or so we've seen a bit of tax loss selling, which happens always in the second half of June. So how do you see the markets in Australia?
Well, we probably should start with the economy, and you know that graph that you put up before about the mortgage the fixed rate mortgages repricing, and it's begun, and it's going to be quite intense over the next 6 months. We already know that, you know, a big chunk of the average Australian consumer's budget is now being spent on shelter, whether it's rent or whether it's servicing a mortgage. And we know that consumers have a lot less money to spend. So I think that if you put it all together, the fact that you know, we've got this dynamic with mortgages repricing, and we look at what happened today with Harvey Norman. You know, they had a big profit downgrade today. The stock was down, I think, close to 14-15%. You know, the consumers out there are doing it tough. So I think the risk of Australia entering a recession before the inflation problem and the economy is finally quelched and put out, I think the risks of a recession have gone up. And therefore, you know, with respect to the stock market, which has been rising, you know, we've seen the ASX 200 put in, you know, it's had a couple of good, quite solid days this week. I still think that there are downside risks to the ASX 200. And if we look at this chart, you know, the big resistance level at the record highs at 7,600. The index is currently mid-range, sort of between sort of 7 and 7,600. So I think the risks are still to the downside, and you know, I'd advocate caution. I think risk sentiment in the Australian market has picked up in the last couple of months, just as it has around the world, and a lot of that is due to the fact that we've seen a much better performance from those US indices. But you know, if we look at the rally in the United States stocks, which has really, you know, lifted sentiment around the world, and a lot of it's been carried by a handful of companies. The breadth has been pretty narrow. So I still think it's time for caution. No new bull market has really started unless you've had really wide breadth, and until the central banks have finished tightening and in fact have moved to a easing bias. We're not there yet in Australia. The RBA is, in my view, is a long way away from easing up on interest rates. In fact, I think there's more tightening to come. And, you know, I think you can make the same argument for the US. So, you know, following this big rally, and we've had a great June quarter, you know, the June quarter has been positive for investors generally. And I can see, you know, that I was looking for a drawdown in the markets in this quarter, and that call has been totally wrong. But, you know, the next quarter could be a different story. And I think, you know, in Australia, the Australian consumer now is at risk for the reasons that we've been discussing today.
Very good points. Yeah. Thank you, Angus. Okay, well, let's move on to the US now, the biggest economy in the world. Let's start off with looking at savings, because one of the big reasons why this particular bear market has gone on for a lot longer than usual and the recession has been pushed out is because of excess savings by the consumers during the pandemic. And you can see this chart, and I'll show you another one in a moment, where the savings went over $2 trillion at the peak of 2021. Since then, we've seen, of course, rates rise last year in 2022 and savings really come down. And at this rate, look, they're currently sitting at about $500 billion. So we've come quite far down already. But at this rate, if this continues by September of this year, all the savings will be gone in the US economy and we're back to neutral. And how do you compare this to historical standards? And this chart shows you very long-term historical household savings. And the biggest savings we've ever seen in recorded history was in World War II in the 40s. And you can see that people were pretty much at home and saving everything they were earning. And that obviously was, you know, went on for many years. Since then, 2020 has been the next biggest, and followed by 2021, these 2 years where we've seen huge savings, and that's accounted to $2 trillion worth of savings. And that's what really has cushioned the fall in the economy to be faster, which hasn't happened. It has slowed it down. And of course, the recession has been pushed out. But as we, you know, work our way through this, we're now starting to see the savings come off. And final couple of points in the US economy is the real spending, which is the blue line here, and the unemployment, the relationship between real spending on goods versus unemployment. And this really is quite an interesting one, because the real spending on goods, the blue line, always is the first one which starts to come down before unemployment goes up. And again, you can look at all the historical standards, including 2008, the real spending on goods started to come down, followed by a rise in unemployment. Of course, we've seen that at the moment as well. The spending on goods has come down quite a lot from 2020, but the unemployment still hasn't moved just yet, partly thanks to those excess savings. You can look at 1990, you can look at 2000 as well. That's the first shoe to drop before the unemployment rises. So this is something we are now starting to see, the goods coming down. The other thing which is coming down is, of course, industrial production. And you can see that here. And again, this is a very long-term chart. And every time it has come down, with the exception of 2015, we didn't see a recession back then. But prior to that, every time industrial production went under in negative territory, we saw a recession. So at the moment, we're not in negative yet, but it is on the way down. So Angus, your thoughts on some of the data, but also the VIX and the AA chart, which is coming up next. The VIX is very low, and historically, people should always buy when VIX has gone up, which means volatility is picked up. That's usually a good time to buy. So at the moment, VIX is at a very low point. What are your thoughts?
Look, maybe just put the consumer savings chart up, because I think that was quite relevant. A couple of points I want to make about the savings rate. The 1940 cycle was very similar to what we're seeing now, where savings were accumulated during the war and then spending was unleashed. We had quite a short cycle back then. It went sort of from boom to bust quite quickly after World War II. And the economy contracted. I think we're going to see a similar dynamic play out because, let's not forget that during the pandemic, the governments printed a lot of money and distributed it throughout the economy. It's led indirectly to inflation, but it's also created a bit of a sugar high in terms of consumer spending. But I think we're now through that, well through that, and consumers have now run down, certainly in the United States, run down their savings buffers. And so, I'm expecting quite a big contraction in spending on consumer durables. And, I think this is already showing up now in weaker PMI manufacturing numbers across the board. And I think, the US, there's a good chance the US will be in recession by the end of the year. There's no question about it. The artificial boost to the economy during the pandemic has now washed through the period of over-earning by corporations when people were out there spending. That's all beginning to unwind now. A lot of those supply chain bottlenecks have also eased. So, I think bottom line, it means a margin contraction for corporates and an earnings recession is coming. In fact, I think we're on the doorstep. So if we look at what the stock market's been doing, the stock market has certainly surprised me this year in the United States. It's led the global equity indices higher, and we've seen volatility fall to historically low levels around 12 or 13. I'm very surprised at that, given the amount of rate hikes have been put in by the central banks and the tightening of financial conditions. Financial conditions are now uber tight. And that typically precedes a drawdown in the stock market. And of course, let's have a look at the positioning. We've got the AAII Bull Bear Index back at the highest level since 2021. And I remember the market came out of the pandemic, the S&P 500 did a big rally from those March 2020 lows straight up. And we're not far off the bullishness that was representative back at that peak in 2021. So I'm cautious. I think a lot of the negative bearish positioning that prevailed in December last year, I think that has all washed out now, and the pendulum has swung, and we're now back on the bull side, where you've got markets are now overbought. Investors have been driven by FOMO. They put cash back to work in the market. Valuations have gone up. So I think the downside risks have increased, not gone down. Number one. Number two, I don't think the bear market cycle has finished yet, because no new bull market has begun unless the central banks are actually easing. We haven't seen that before. It's unprecedented. And of course, number three, the rally itself has not been accompanied by a lot of breadth. You know, it doesn't matter which market we're talking about. It's just a handful of stocks and a few sectors that have driven the outperformance. And for a bull market to be in place and for it to continue, we really need to see the rally broaden to other sectors in the market, and we're certainly not seeing that at the moment. So I'm still advocating caution, Roger,
Yes.
and particularly as we enter the July, August, September quarter, which is, as we all know, is typically can be quite seasonally volatile. And I'm particularly concerned about those tightening financial conditions. We talked about consumer spending and the US consumer being tapped out. Well, the US government is now being forced to rein in their spending. And that was part of the agreement with the Republicans. So the spending and the money coming from the government is no longer going to be there in the US. And I think financial conditions are going to contract even further now that the government is effectively replenishing the treasury coffers. They're selling a lot of bonds. That's going to drain a lot of liquidity out of the system. So cautious is the word.
Absolutely. And look, all those points on top of the bond market, I think that's the final point here to make as well. The 2-year bond yields still in a bit of a rebound after a correction a few months ago, and similar to the 10-year bond yield. So I'll take your point on those two, please.
So consensus at the moment amongst all the investment banks is that bond yields are going to start heading down soon. That bonds represent a good place to park money, and that, you know, they've got a good risk reward skew and the yields will be lower. I think the consensus estimate amongst, you know, several investment banks that I follow is for the 10-year bond yield to fall to 3.5 by the end of the year. This chart to me looks a bit like the S&P 500 did 3 months ago. It looks like it's on the cusp of a breakout. And in fact, that's my call. I think the 10-year bond yield is actually going to go up, and it's going to break out on the top side in the next few months. That's my that's the way I look at the this particular chart and the technical setup. You know, we've seen a consolidation since those October highs last year, but topside resistance is now being pressured. The 10-year is quietly bubbling away below that big resistance level, and I think there'll be a catalyst coming in the next month or so that forces the 10-year yield up. That's not going to be good for growth stocks. It's not going to be good for those mega cap technology stocks that are particularly sensitive to higher bond yields. I don't think it's going to be good for the stock market generally, but some of these mega cap tech stocks could be facing, you know, quite a significant reality check if those yields start breaking out on the top side. So that's my call. Of course, we've still got the inversion in the yield curve. We've still got that inversion, which, you know, signals a recession. But, you know, the chance at the moment that the bond market or the money markets have pretty much removed the probability of it was pricing rate cuts by the end of the year. The futures markets have moved away from that now to little or no chance for rate cut this year. And in fact, we're probably likely to see one more final hike from the Fed before the end of the year's out.
Yes, it was starting to. Yeah, you're right. The bond yield difference between 2 years and 10, which is on this chart, was starting to head back up, but it's now been pulled straight back down. So I guess the market is telling us exactly what you said, and no more rate cuts this year. We'll look at the S&P and the Nasdaq now. The S&P is still in that range, is still in that uptrend. we started to see a little bit of slowdown in the last few days. 24 hours ago, we saw a bit of a rally as well. So all in all, still in that range. How do you see the price action?
Well, we shifted to being tactically bullish from a technical perspective on the S&P 500 when it broke through that resistance level at 4,200. We've seen the run now and the upside extension up to 4,400. I think, that's to be expected. That was pretty much what I was looking for the market to do. There's now quite a big resistance level at 4,400. So I'm expecting a decent reaction now and a drawdown. And I think at a minimum, the 4,200 level gets tested on the downside. That 4,200 is now a support level. So the big question is going to be whether the bulls are right, in which case 4,200 holds and we see the S&P 500 continue to climb a wall of worry, over the next 6 to 12 months. Or does the bear market reassert and does the index break down below 4,200? We will know the answers to those questions in the next several months. But as I said, I think the risks of a drawdown near term to 4,200 and a retest of that support level are high. And I also think there's, and have quite high conviction that this earnings quarter is going to be problematic for US corporations. It's not going to go the way the previous quarter went. For all those reasons that we talked about today, consumers tightening the belt, they're not spending the money on durable goods. So I think there's downside risk to the US indices and by definition, downside risk to global stock markets in the months ahead. And again, with the Nasdaq 100, this just illustrates, how narrow the rally has really been in the US market. Just a handful of companies really driving the bulk of the rally. We can see how overextended the Nasdaq 100 has become. It's hit a big resistance level, which was a support level when the Nasdaq 100 broke last year. It's now within 9% of the record highs of January last year. So I think there's a reset coming with this index as well.
Absolutely. The big tech stocks have had a phenomenal run this year. They're up combined 50% between the 7 companies. Unbelievable. But also the difference between the Nasdaq and the 10-year bond yields is now widened. As you can see, the orange line at the top, that's the Nasdaq 100, and the purple line at the bottom being the 10-year bond yields. Yeah, that gap is widened, and that usually is not what you'd expect. When bond yields are rising, you expect the Nasdaq to come down, but I guess something's got to give in the coming months, Angus.
Yeah, so the Nasdaq has certainly defied rising bond yields, and which is unusual. And I think this gap that's opened up, is about to be closed. And if I'm right in my view that there's a topside breakout in the US 10-year bond yield, we would expect a sharp drawdown in the Nasdaq, and those Nasdaq stocks, which are particularly sensitive to bond yields. So this graph, this rebasing chart, just says to me that there's a disconnect between what the bond market is doing and what the Nasdaq's doing, and if anything, it's a time for some caution.
Absolutely. So don't go out and buy those tech stocks today. Is I guess the simple message. To finish off today, we'll look at the greenback and gold. So the US dollar is also going pretty much sideways now for some time. But how do you see that? It's getting closer and closer to that big support of 101. What are your thoughts on the US dollar?
Yeah, so look, the big blue line, this is a 2-year weekly chart, but that blue line is the primary uptrend on a 5-year weekly chart that was broken by the US dollar index. It was broken, and then the rebound rally, the tactical rebound rally in the greenback, which I was foreshadowing probably about a month ago. That's all played out now, and we've seen the US dollar index stall around that 104, 105 level. It's now mid-range, below the primary trend line. So I think this pattern and this technical setup is looking bearish at the moment. I mean, a breakout above the red dotted line resistance would perhaps jeopardize that view. But it seems to me like we're getting a trend of lower reactionary highs, a lower series of highs. And we've had 2 tests of that 101 support level. So I think this chart looks bearish, Rog. And I'm looking for a retest of the 101 level.
Okay.
But, the dollar could meander in a range for, several more months yet. I think a lot of it's going to come down to what the global central banks do with rates versus the Fed. And certainly if we see more rate hikes around the world, more on the way in Australia, I think, more on the way in the UK and Europe, we may well find that those interest rate differentials close, and that puts more downward pressure on the dollar. But the overall technical setup looks quite looks bearish to me. It's got a bearish bias to it, this chart. Yeah.
Okay. So look, if the US dollar does come down in the short term, I guess that's got to be good for gold. And I know you've published that in the your daily email yesterday, that you think gold is now looking good because the US dollar's trend is looking like it's going to break to the downside. So how do you see gold at the moment?
I think gold's still correcting. After hitting the record highs a month or so ago, until we get a clearer view on the US dollar and where it's going, I think the gold will continue to consolidate. But this whole chart setup and this structure, this is a 10-year monthly chart, is very bullish. We've now had 3 tests in the last 5 years of those record highs, and I think the big multi-year consolidation in gold is coming to an end, and we're going to see a topside breakout at some point this year. Near term, it's consolidating, still in correction mode, but this chart pattern is bullish. The setup is bullish, and I still think there's value in a lot of those gold stocks, which are well down from their record highs of a few years ago.
Okay, very good. So I guess the message for investors holding gold stocks is, look, if you look into dollar cost average and buy a few times, and then the opportunities are looking good at the moment, and there probably might be some more better opportunities coming in the short term. If you completely missed out and you haven't bought any gold at all, then I guess you can start looking at some of our gold recommendations on the website, and we talked about it, a few of them last week's webinar as well. So look, good information today, Angus. Thank you for that, and I hope the members are starting to get a feel of how things are shaping up. Look, it's the end of financial year. A lot of members probably have adjusted their portfolios for maybe profits versus losses, as most investors would do. It may be time to look at your cash levels. So we did talk about that in last week's webinar with David and myself, and to suggest that you may want to look at your cash levels, look at your portfolio, and trim down a few things to get ready for what we think is some opportunities are coming and lining up in the coming few months. Of course, we'd all like this bear market to end pretty quickly and we can all get on with our lives and get into a new bull market, but time has got its own little cycles. We have to respect that and we have to wait. So look, on that note, I'll pass it on to you, Angus, for your final words, and thank you once again for your insights.
Thanks, Roger. It's always a pleasure joining the webinar with the members and with you. And also just a reminder that next Thursday we will be back to doing live. It'll be a live hosting So I'll look forward to all those questions that we typically get inundated with, and look forward to joining you same time next Thursday. Bye for now.
Thank you.